Hello, federal employees. This is Sierra with Plan Your Federal Retirement. Thank you for joining me on today's Follow-Up Friday, where I will be covering the highlights and action items from this week's episode. In episode 85, Micah Schlansky and special guest JT Farron, CFP at Schlansky & Associates, discussed TSP spillover and funding. A new client had an interesting question about the TSP. TSP is a phenomenal tool for saving for retirement. There are 3 stages of retirement: accumulation, preservation, and then distribution. In the accumulation stage, that's where you save and build money. During the preservation phase, you have enough money, but now how do you keep it? And then finally, during the distribution phase, how do I take money out of my account but never outlive my money? During each stage, we have to think about our investments differently. Our focus right now is on the accumulation stage and how powerful the TSP can be in that stage. Micah asked JT, how much money should someone save for retirement? JT says that it really comes down to your long-term plan, your goals, and your cash flow. Figure out how much you are spending now and how much you're going to be spending in retirement, and then walking back into that number of how much you need to save. Micah agrees and says that it's really a depends question. Micah also added that what you're spending today is probably what you're going to be spending in retirement, if not more. A big mistake that comes up from clients is sometimes they think they're going to spend less in retirement. Sometimes thinking that, for example, I don't have to commute anymore, and that's going to save me a ton of money. JT says that federal employees retire much younger as well. If you retire at age 57, what are you going to do in retirement? You probably want to go out and have some fun and pursue your dreams, which does cost money. Micah brings up another aspect of federal retirement, and that you have a fantastic pension plan. People often read articles about retirement, and one of them might say you need to save 20% in order to retire. But for federal employees, they do have a tendency to retire much earlier. We really got to factor that pension in because that's a big part of your retirement as well. JT brought up the 3 pillars of federal retirement. Your first pension, your TSP, and Social Security are the 3 sources of income in retirement. Micah reiterates that you do not give generic investment advice because you don't know their specific situation. However, Micah said that every single federal employee should be putting in at least 5% into their TSP. If you put in 5% into your TSP, you are going to double your money because the government is going to match that. That means there's going to be a 10% contribution between your 5% contribution and the 5% match. Now, this is the minimum. We do not know the maximum for everyone just yet. JT agrees and says that this is money you're leaving on the table. If you are not going to do the full 5%, you're missing out on that, and that is a benefit you earned that is a part of your compensation package. Micah asked JT, what is the cap on how much you can put into the TSP? JT says that for the year 2023, it is $22,500. And if you're over the age of 50, you can do an extra $7,500 for a total of $30,000 a year. Micah agrees and says that it is the year you turn 50. For example, if you turn 50 in October, then you can start that contribution in January of the same year. Micah and JT had a client that asked about if he could do a catch-up if he missed on the catch-up the previous few years. Could he go back and catch up on those years? JT explains that each retirement plan have a little bit of different rules, but the catch-up means that you can save a little bit more if you weren't able to save enough for retirement. The catch-up is per calendar year, January to December, via payroll deduction. So you wouldn't be able to go back in previous years. If you missed it, you unfortunately can't go back. But the great news is that you can make those contributions going forward. Micah asked that if you are contributing the max into the TSP, could you also put that into your traditional and Roth? JT said no, it is a $22,500 total for the TSP. You can choose where that money goes into though. Micah reiterated that it is something that everyone should evaluate because there's a big misconception about the taxes being less in retirement. But they're actually probably going to be more and higher unless you do some tax planning to help reduce those into retirement. JT also brings up that he recently had a client with a question about the TSP spillover. There is a spillover rule with the TSP, and the rules did change in 2021. The spillover is more of an administrative change though. It doesn't change the amount of contribution or how you're going to make that contribution, but really it's just the accounting behind it. Micah adds on that if you funded the TSP earlier in the year, and say it's fully funded by October, if you are eligible for the catch-up spillover, then that money automatically dumps into the catch-up contribution, and that's an extra $7,500 a year. It does not spill over, however, into the next calendar year. If you contribute over $30,000, so $30,000 and $1, it is not spilled over into that next year. Micah reiterates that it's important to know how much you're saving into the TSP. We recommend that you set up your contributions at the beginning of the year for the 26 pay periods and just leave it alone for the whole year. Micah asks about how much you can contribute to the IRA, whether it's traditional or Roth. JT says that the amounts just changed for 2023 and it's $6,500 per person. Or if you're over the age of 50, then you can contribute up to an extra $1,000 a year for a total of $7,500 for the year. Micah brings up the misconception about when people make too much money and they can't fund the IRA accounts, but that isn't true, is it? JT says that it's not true, you just can't deduct it when you contribute to the traditional IRA. Micah says that we have clients who use TurboTax, for example, and they get this big pop-up warning about they made too much and they can't deduct the contribution. Micah says that we get calls about this and clients think that they couldn't have contributed to it. But they can, they just can't deduct it. If you make too much, then there's always ways around it with what's called a backdoor Roth IRA funding, but we need to be careful about how we do it. Micah brings up HSA accounts and how to maximize your HSA. You have to be in a high deductible healthcare plan, and Micah says that you should evaluate your health insurance every year. If you're able to contribute to an HSA, you can not only save pre-tax, but you also get to invest the money, and then the money is able to grow 100% tax-free. JT says that for 2023, the contribution limits are $3,850 per person or $7,750 per couple married filing jointly. If you are over the age of 50, then you also get to do an extra 1,000% contribution. Micah reiterates that this is a super powerful tool. Micah says that if he goes to the doctor and can cash flow those expenses, then he's not going to use the HSA money. He keeps the deductible in cash, but anything above his deductible is invested. Micah brings up that any money that you need in the next 5 years should not be invested. For our clients, if they're able to save an extra $7,000 over the course of 20 years, that's an extra $140,000 growing tax-free. That is a massive savings tool. JT talks about if you need to pull the money out, it needs to be for qualified medical expense. There's a really long list of things that do qualify, and to save your receipts or use some sort of accounting method to keep record of that. Then Micah brings up a hack and says that it's not a calendar year expense. If you have a record of all the expenses you paid out of pocket, say for the last 10 years, you can pull that money out as one lump sum. Once you reach the age of 65 years young, you can pull the money out without penalty, but you do have to pay taxes on it. JT reiterated that this is like getting an extra IRA then. This podcast is all about action items for our listeners. Micah stole my action item, but his first action item is to share this podcast with a friend, and with your help, we can achieve our goal of helping 1 million federal employees just like you. JT's action item is to contribute at least 5% into your TSP. Third action item, Micah adds on to review your TSP maybe quarterly, for example, and to see if you can increase your TSP contribution. 4, JT's next action item is that we have open enrollment coming up soon. So go review HSA eligible healthcare plans and see if they could be a good fit for you. 5, Micah's next action item is to look at traditional and Roth contributions for the next year and get those changes set up so that you can get set up for your retirement. 6, re-listen to the original episode to hear the great conversation with Micah and JT. And 7, if you're in Anchorage, Alaska, register and block out time on your calendars for our next live seminar on October 11th. Until next time, happy planning.